Hi, I'm John Scherer, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan, Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. And before we go on to talk about different types of bonds, please hit subscribe. All right, John. So I want to talk about bonds. All right.
Awesome.
Yeah, when I started in the industry, I thought I knew a lot about bonds, but actually there's kind of knowledge and then there's practice. So there was a gap between those two things for me because I had learned a lot about it in school, but then when I actually got into advising people about it, there was a difference. And actually, I got a lot of the information from ACP or the Alliance of Comprehensive Planners about how to do it in practice. So what I thought we'd do today is talk about all the different kinds of bonds and just talk about how we use them or don't use them. All right.
I
So
think I think that's great.
yeah. So the first thing we want to talk about is treasuries. These are backed by the US government. Okay. And there's two flavors that I want to focus on. One is T-bills and one is known as treasury strips. Why don't you explain what the difference is?
One of the things that you made me think about as we're talking about this, government bonds, right? Treasury bonds, and why are they useful? Like why, and in general, they pay a lower interest rate than some other things you can buy, but they're backed by and you said they're backed by the government. What does that mean? That means that the government says, listen, Mrs. Investor, you give us $100,000, we'll pay you interest, and then we'll give you your $100,000 back at the end of the period, right? It's sort of like a CD type of a thing. Well, the government can print money, right? They can actually literally make good on that. That's why you might loan money to the government, let them borrow it from you. A treasury bill is a short-term bond that the government issues. A treasury bond, you buy T bonds a little bit longer than that. And the thing when we talk about strips and we use them for retirement income, I know you do as well. But what that means is when you buy a bond, think about it like a CD, right? I buy a CD, it pays interest on a quarterly basis, semi-annual, depends on the terms, right? But it pays you interest over time, then they give you your money back. With a strip, and that's the way a bond works as well, but with a strip, they say, listen, we're not going to pay you interest every quarter or every 6 months, but you can buy the bond at a discount that builds in that same amount of interest,
Right.
right? So just sort of theoretically, I could put $100,000 in if I'm getting 4% interest on a bond, on a treasury bill. I get $4,000 a year in interest. They just pay that to me, and then they give me the $100,000 back at the end of the term. With a strip, they kind of bake that quarterly payment in, and they say, and it'll be something like, oh, you buy this bond for this stripped treasury bill for $92,000 or something like this, and then it grows. You don't get payments every quarter, but at the end of the term, you get 100,000. So the growth is kind of baked in, and that makes it really easy when we're talking about funding retirement income and those sorts of things. So that's the difference between those, as I see it.
Yeah, I agree. So there's a couple of things I want to pull out with what you're talking about. The first is so strips versus treasuries. There's not that much difference except for when they pay, right? That's
Yeah. How
there's
you get your money out. Yep.
the other thing is that they can go for a long time. So you can buy them for 5 years, 10 years, 15 years, 30 years. I think they go up to 30 years, right? And with shorter terms, though, you can buy T-bills, right, or notes, but we often use CDs in that situation and buy CDs because, again, they're backed by the government and they might pay a little higher interest. Okay. And
Mhm.
we see the difference between FDIC insurance and uh, treasuries as six of one, half a dozen the other, pretty much the same.
Yeah.
So usually when we're buying, we'll buy CDs for the first 5 years. And then after that, we'll buy treasuries because we like the safety of it all. But that decision is totally decided on what interest rates are they paying because
Yeah.
underlying they're safe.
No, I think and as we'll get on to some of the other types of bonds, I mean, one of the big factors in this is the risk that you take. And by risk, what I mean is if I'm going to loan the government $100,000, I've got a pretty high likelihood they're going to pay me back at the end of the term, right? When
Right.
I buy a CD and it's FDIC insured, I buy a CD from, Phil in the bank. If they go out of business, I could lose my money, except for FDIC insurance, right? I mean, it's a pretty certain thing. As we get into other types of bonds, you're relying on that organization that issues the bond, whether it's a local government or it's a company, to pay you back. And again, most of the time it works out. I don't know, 99% of the time. But when companies go bankrupt, there's some risk in there, and that's what we need to think about. These treasuries and CDs, FDIC insured things like, nope, the risk of them not paying you back is probably not zero, but really, really, really close to zero, right?
Right. Well, it's considered zero.
Yeah.
And so the other thing I want to talk about is tips, Treasury inflation protected. And it seems like these could be useful if you're specifically concerned about inflation, but that when you're looking at it from a completely intellectual level, they are not generally don't pay off better unless you had figured out when exactly the timing is it's going to pay off more. Is that your attitude about it, or you have a different attitude about tips?
Yeah, no, I agree with that. It's tied to inflation, right? So it's treasury, so it's tied with inflation, so it does maintain purchasing power, but you pay for that, right? It's almost like an insurance sort of component, not strictly insurance, but I'm giving up some potential return for having this inflation protection. Not wrong, and we'll use tips and for the right clients with things, but it's not a free lunch necessarily, right? So you just need to know what the trade-offs are.
Right. Then there's also bonds that are not 100% guaranteed that are issued by the government that are for different things. Do you know much about those?
I'm not familiar. I'm not sure. I know what you're talking about with that.
Like the agencies of the government that are not necessarily US government. So it's like the types of agencies like say Sally Mac or Freddie Mac that
Yeah.
it's pretty much covered by the government, you think, but it's not necessarily the printing money element that you were talking about before. Like so there's
Yeah.
slightly more risk there. That's what I'm saying.
Yeah. Yeah. And we have some Tennessee Valley Authority
Yeah.
bonds that we buy, Fannie Mae and Freddie Mac, where it used to be basically before the credit crisis, where they're not guaranteed, but we think they are. And then, as I
Right.
understand it, the government came out and officially said, no, no, we're backing these up. So to me, that's like FDIC insurance.
Okay, cool. All right, now let's move on to munis. All right, so someone is backing these. What are your thoughts about munis? They also, if you're in the highest tax bracket, they should save you some federal income tax. I will say that's true.
Yeah.
But most people just they get sold to these and they're not in the highest tax bracket. They're just in a regular old tax bracket, 24, 22, or even 12. And they just don't like paying tax. In that situation, I'm curious about your take. I generally don't like munis. I generally don't like munis. And my reasoning is you can't figure out what the risk is because
Yeah.
I live in Illinois, and I could not, for the life of me, try to figure out how to figure out what the risk is. How much interest they're paying is based on the perceived risk. And with the federal government, that's pretty easy. The market does a good job of calculating that. But with these munis, I just don't think the information is even available. What are your thoughts?
Yeah, and I'll call it the jargon police on you, Bridget, here, that
Oh,
municipal bonds, right?
so,
Issued by the government, but
yeah,
municipal governments, not federal or state governments, right?
right.
And so, and there's tax advantages to them, right? So again, as you mentioned, a high tax bracket, then you get there's tax free income on those things, right? And it's exactly what you said, though. If the taxes are a huge factor in your financial situation, it can make some difference. It can make some sense, I should say. But how do you evaluate the underlying risk? Counties there are counties that issue municipal bonds. Counties have gone bankrupt. What happens? And I can't remember how long ago it is now. Orange County out in California, the counties went bankrupt. Well, what risk are you taking with that, right? And you give up some return typically, most of the time compared to buying a treasury bill or a treasury bond, buying a municipal bond, you're going to get a lower interest rate. Why? Because of the tax advantage, right? So it all sort of is baked in there. So it can be a good tool, but sometimes we think, oh, tax deferral, awesome. And you just described it. Man, if you're in the top tax bracket, yep, it makes a bunch of sense. If you're in one of those middle or lower tax brackets, you go like, you're getting a lower return, again, most cases, and taking some perhaps unknown risk or unquantifiable. Like, why do that? It just doesn't seem to fit the plan usually.
Yeah. Okay. So then we already talked a little bit about CDs being interchangeable in my mind with treasuries. Like I'll just try to figure out which for 0 to 5 years, I'll just look at which is paying higher interest and go with that. Is that your approach on CDs?
Yep. I mean, again, FDIC insured, it just becomes an interest rate, pretty
Yeah.
simple math.
And where are you now on I bonds? So with I bonds, you don't pay tax on the interest or some until you take the money out, and you can put $10,000 a year in, and it generally has a attractive return, especially if inflation is high. So it's meant to protect against one thing that some people are particularly worried about, which is inflation. Now that inflation is still a concern for a lot of people, but it isn't that high. Where are you with are you recommending I bonds much? Where are you at with it?
Yeah, and it sort of depends on the person, right? Where your situation is. But for people who don't need the money and are concerned about inflation, I mean, one of the things about, it's not necessarily, there was a time right a couple of years back that we have plenty of episodes on I bonds were a screaming deal relative to what else is in the marketplace. Not that case today, but you can only buy $10,000 a year worth, right? And so to have some of those in here, if we see inflation again in the next, 5 to 10 years, I think you might be happy. A person might be happy to have a bunch of money set aside in T bonds or in I bonds, I should say. And so for those reasons, when people got, extra money, let's call it, like, where do we put this? That can be a place that's not gonna, it's not gonna make or break a person's retirement income, sort of a thing. But at the same time, it can be a nice tool in the toolbox when inflation comes around again. So we're sort of largely neutral, but I'm not in a big hurry to sell those things. How
Yeah,
about
totally agree. It's like they're a nice if you've got, if you're saving in all these other pockets, and then you're like, oh, what else? I need some money that's safe. And this will pay maybe hopefully a little more than a money market, but just in that same category. But it is accessible. So when you need it, it takes maybe a day or two to get the money.
yeah,
So that's my experience. And so that's awesome. That's like a savings. It's like a savings account that's earning a little more, which is great. Uh,
yep,
although it's tied to inflation. Okay. And then last thing is corporate bonds. So this was a surprise to me when I started in the industry because corporate bonds typically pay more than the treasuries, right?
yep,
And more than munis. But I was really influenced by Burt Whitehead's thinking on this, which is that similar to munis, it's hard to judge the actual risk of the of individual corporations, and you might not get paid back. And if you really like the company, why not just invest in their stock and actually have some upside? Because there's no
mhm,
upside. The only, getting paid back, is that an upside? Like getting the interest that you're supposed to get, that's supposed to be an upside? That's not an upside. Invest in treasuries, and then when you're trying for growth, invest in the stock market. That was an approach that I've adopted, but that I didn't know about when I just had book learning.
yeah, yeah. No, and I don't know that I have too much to add to that because that's exactly, our take on things. Like, and we use the farmer analogy with our investments, right? I know that, we've talked about that before, but make money in stocks. That's where the farmers, make money out in their fields when they grow their crops. And then when you need things that are safe and reliable, you put those down in your pantry, right? You can pickles and applesauce and put them in your pantry. That money, that stuff doesn't grow. So your bonds, we're not looking for growth. We're looking for the money to be there when we need to eat it, sort of a thing. So that sort of mentality of, don't try to get growth in your pantry, so to
Right.
speak. So, yeah.
All right, very good. So with that, it seems like a great time to wrap it up. I'm Bridget Sullivan Mermel. I've got a family financial planning practice in Chicago, Illinois.
And I'm John Scherer. I've got a fee only financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on clients. We'd love to hear from you, but we're also both members of the Alliance of Comprehensive Planners. So if you like what you hear on our show and would like to find an advisor in your area that thinks like we do, check out acplanners.org.
And don't forget to subscribe.